Welcome back to the deep dive. Today we are strapping in for what feels like a high-speed collision with a lot of conventional financial wisdom.
That's a good way to put it.
We're diving into a collection of sources that offer this truly contrarian philosophy of how you build wealth. And the core idea is that the key to massive long-term returns isn't doing more.
Right. Not more charting, not more checking, definitely not more trading.
It's aggressively, and this is the weird part, doing nothing.
It's a concept that sounds, almost absurd until you really dig into the math and the psychology behind it.
So that's our mission today.
Yeah, to unpack this idea. Because the central, and I think most provocative claim in our source material is this. The single biggest lie that haunts the investment world,
Okay.
especially among active traders, is this belief that immediate stop loss is iron law.
That is fighting words. I mean, we're taught from day one of opening a brokerage account that risk management means cutting your losses quickly. You tell the average investor to just ignore that and hold through a downturn, they'd call you reckless.
And that's the emotional conditioning that Wall Street really relies on. Our sources define the true first principle of compounding as the exact opposite of that constant meddling.
The opposite. Okay, so what is it?
It really just boils down to three things. First, non-essential non-interruption.
Right.
Second, reducing what's called transaction friction. And third, and this is the big one, avoiding stopping your losses too early.
So the goal of this deep dive is to really understand why all that busy work that so many investors equate with being responsible
Yeah, the daily account monitoring, the little tweaks.
is actually not just inefficient, but actively, detrimental.
Yeah.
We're focusing on the hidden psychological costs just as much as the actual financial drain. Let's jump in.
Let's do it.
So if the name of the game is accumulating wealth, why is being active so corrosive to compounding? I mean, people feel productive when they're busy. They feel like they're managing risk.
They think they're managing risk, but what they're actually doing is introducing what the sources call transaction friction.
Transaction friction.
Yeah, think of it this way. Compounding is this powerful engine, right? And every single trade you make is like throwing a little bit of grit into the gears. You're just weakening the engine's power with every single action, every decision. And most people, they only focus on the visible costs.
The commissions, the taxes you trigger, price spreads.
Exactly. The stuff you see on your statement.
And those costs are bad enough, especially when you think about them compounding over decades.
Agreed.
Yeah.
But those aren't the true killers. The material is very explicit on this. The true killers are the invisible costs.
The psychological ones.
The psychological ones. Decision fatigue, emotional fluctuation, cognitive bias. Every single time you analyze a stock, decide to buy, set a stop loss, and then decide to sell, your brain is expending energy. And that mental resource, it's finite.
So it's not just the money you lose in the trade, but the mental stamina you lose for the next good decision.
Precisely. That fatigue makes your judgment weaker for the next opportunity. It increases the probability that you're going to make a mistake.
And you see this cycle over and over.
You see it most clearly in people who trade hundreds of times a year. They're not really investing. They're in a high-stakes battle against their own nervous system.
And their need for control.
A need for control that, ironically, often results in them trading away their future capital.
That really explains why constantly watching the market feels so exhausting. That psychological drain is real. And the sources have this simple, really powerful analogy for this.
They do, and it's all about that relationship with time. See, compounding isn't fundamentally a math game. It's a relationship.
A relationship with time.
With time, yeah.
Yeah.
Think of your capital as a tree you've just planted.
Okay, a tree.
Now, what if you felt this constant need to dig up that tree every 3 days just to check if the roots are growing?
You'd kill it, obviously.
You'd kill the tree, and you would call it dynamic portfolio management. You never give it a chance to anchor itself and grow exponentially.
So time is compounding's greatest friend, but if we interrupt that relationship with our own impatience, we just void the contract.
Exactly. Time is patient, but it does have a temper. If you constantly interrupt it, it stops playing. The thing is, good businesses, fundamentally high-quality assets, they don't need constant tending.
They need space.
They need space and time to execute. The irony is just, it's that the people who look the busiest, the day traders, the account checkers, are often the ones doing the most long-term damage to their own wealth.
Which brings us, I think, directly to the biggest emotional trap of all, the premature exit.
Oh, this one is painful.
Because people often do the hard part right. They identify and buy a genuinely great asset, but then they lack the staying power for it to transform from a good investment into a great thing.
And we all know that feeling, right? That feeling of a successful early exit. You buy something, it pops 20 or 30%, and you sell. You feel so smug.
A genius for a day.
You feel like a genius for locking in that quick gain.
Yeah.
But the Amazon anecdote in the sources is just the perfect painful example of this.
It really is.
I mean, just imagine being that investor. You bought Amazon in the early days, you watched it climb 30%, and you thought, hey, that's a nice profit, I'll take it off the table.
You made money. You can't be faulted for making money.
You successfully booked a modest gain.
Yeah.
But then you were forced to watch from the sidelines as that same stock climbed 50, maybe 100 times higher over the next 2 decades.
Ouch.
You thought you were playing it safe, managing your risk, but in reality, you were sacrificing life-changing returns for a tiny, fleeting feeling of validation.
And that's because the nature of compounding means those early gains, they're barely the warm-up act. If you get off the ride, then you've missed the entire show.
Absolutely. The real magic of compounding lies almost entirely in that accelerating exponential growth.
A hockey stick curve.
Right. And that explosive part of the curve, it occurs in the latter half of the investment period. The first few years are almost linear, you barely notice them.
So jumping off after that initial linear part.
Even if you made a small profit, it's like running 90% of a marathon only to quit 100 feet from the finish line.
Yep.
You just reset the clock. You trade that exponential potential for a little linear profit.
This really makes the whole doing nothing strategy look, well, it looks a lot more like an extreme discipline than it does laziness. It requires an almost stoic patience.
It is the ultimate test of your conviction.
Yeah.
I mean, you look at the real-world examples of non-interruption.
Warren Buffett.
Warren Buffett holding Coca-Cola for decades, even when it went through these long, stagnant periods. Or Berkshire holding the Chinese EV maker BYD for over a decade.
Right.
This strategy proves that if your fundamental analysis, your initial homework, is solid, the correct approach is to simply put the money to work and then get completely out of the way.
Your job is selection, not management. Okay, let's address the core anxiety then. The thing that drives those early exits and all that constant tinkering? The fear of loss. If a stock starts dropping 10%, that's why we're taught to set those mechanical stop-loss lines, right? So why are the sources so emphatic that relying on a simple percentage rule is often a catastrophic mistake?
Because it operates on a profound, just a deep misunderstanding of what risk actually is.
Okay, redefine risk for us.
Our sources contend that true risk is buying the wrong thing, period.
Just buying a bad company.
It is owning a fundamentally bad or a decaying business. If you buy a pile of trash, 100 mechanical stop losses won't save you from the eventual fact that you bought trash.
Okay, but I have to challenge that a little. That sounds incredibly high risk on its face. I get the philosophy of buying and holding quality, but in the real world, volatility can be just extreme.
It can.
So if I'm looking at a quality company and the price drops 40% and I stick with this mantra of non-interruption, I've lost a massive chunk of my capital. And what if someone is using even a tiny bit of leverage? Surely a hard stop loss is necessary there to prevent a margin call from wiping you out, even if the company itself is sound right.
That is a critical distinction to make, and you're right to bring it up. The philosophy we're discussing here absolutely assumes two things. First, that you have sound capital allocation, you bought the asset at a reasonable price. And second,
no leverage.
That you are working with an unleveraged portfolio. The moment you introduce leverage, you introduce a systemic risk that demands mechanical intervention. You have to protect yourself from a margin call.
Got it.
But for the core investor, the message is clear. If you've done your homework and bought a sound company, a short-term drop of 30 or even 50% is not a reason for a stop loss.
It's an opportunity.
Precisely. It is an opportunity to add to your position at a discounted price, provided, and this is the key, provided the underlying business fundamentals have not changed.
The health of the company is still good.
Exactly. A true exit, a real stop loss, should only happen when those fundamentals change. A management scandal, a sudden loss of competitiveness, a total failure of the business model.
Not just because the price hit some arbitrary number.
Mechanically selling, just because the price hit a 50% drop, is substituting a simple emotional rule for critical, fundamental judgment.
And this intense focus on fundamental value, it basically dismisses the entire school of day trading and technical analysis.
It does, unequivocally. The material highlights the utter futility of technical analysis when you compare it to long-term value creation.
So all the charts, the moving averages.
Day-to-day trading, looking at technical indicators like the MCG or Bollinger Bands, it's all characterized as useless noise.
But why is it noise? I mean, a lot of traders swear by those tools.
Because they only look backward. They reflect historical price action and market sentiment, not the actual forward-looking value generation of the business. They make simple things overly complex.
So what's the simple version?
The successful long-term investors highlighted in our sources, they focus on just 3 things, and they're deceptively simple.
Okay.
1, is the business fundamentally good and durable? 2, is the price reasonable relative to its long-term potential? And 3, is the management reliable and trustworthy?
Get those 3 right.
And the rest is literally just waiting and resisting the urge to interfere.
But waiting is the most difficult human challenge. I mean, we are just wired to equate action with value. We think the expert has to be busy.
Right.
But in this specific domain, the busiest people are often just digging their own holes. They're creating that destructive transaction friction themselves.
That's the paradox of activity. Our culture rewards action and control. But investment success requires you to resist that instinct, to tolerate boredom, and to look like you're sleeping while everyone else is panicking.
The real work is all up front.
The real work happens before you buy, during that fundamental analysis. After the purchase, the best move is usually inertia.
This is where we have to bring in that great analogy of Mr. Market.
Mr. Market. He's a perfect personification of the market's manic, unstable mood. More changeable and emotional than, June weather.
He shows up every day.
He visits you daily, and he offers to buy your shares or sell you his shares at prices that are completely dictated by his own emotional state.
Whether he's euphoric or deeply depressed.
Exactly. He is there to serve you. He offers you low prices when he's scared, so you can buy, or high prices when he's greedy, so you can sell. But he is never, ever there to guide your judgment.
And the most foolish thing we can do is let his mood swings, the daily volatility, influence our decision to act.
Absolutely. The decision to buy or sell should be based on a fundamental change in the business, not the temporary mood of Mr. Market. When you let his volatility get to you, you stop being an investor.
You become a reactive participant in his neuroses.
Perfectly said.
And compounding that reactive behavior is our own natural human flaw of overconfidence, which brings us to the circle of competence.
Overconfidence is fatal here. Most people genuinely think they can predict macroeconomic cycles, or that they understand complex, bleeding-edge tech stocks.
And the sources are pretty blunt about this.
Very blunt. They say 99% of people are deceiving themselves when they step outside their knowledge boundaries. The key insight from someone like Charlie Munger is that his strategy involved avoiding 1,000,000 times more opportunities than he actually took.
Why?
Purely because he knew his boundaries. He knew his circle.
That's wisdom, not cowardice. Knowing what to avoid is often more important than knowing what to buy.
It's the highest form of discipline. If you're operating outside your circle, you're not operating on courage, you're operating on ignorance and speculation. And there's a really simple test for this.
A test for the learner.
A test for any of us. If you buy an asset and you cannot sleep at night without constantly checking the price,
You messed up.
it means you either bought the wrong asset or you bought way too much of it. Investment should fundamentally simplify your life and reduce your anxiety, not multiply it.
When you zoom out, the core philosophy we've been exploring is what you could really call an anti-human game.
That's a great way to describe it. Human nature craves speed, action, complexity. But successful investment, it requires slowness, stillness, and just radical simplicity.
The idea that once a portfolio is set, any adjustment is an energy loss. It almost sounds like it's borrowing from classical physics.
It's the inertia principle. Once you have momentum with a quality portfolio, every external force you apply, every trade, every adjustment, it comes with an energy cost.
Yeah.
A loss.
And you see this in the data.
We see this empirically. High portfolio turnover, which is just frequent trading, is consistently and negatively correlated with superior returns. The more you move, the less you ultimately earn.
Because all those frequent interruptions are systematically converting that beautiful exponential multiplicative growth
back into painful linear accumulation.
It's like you keep starting over.
Exactly. The continuous exponential growth you get by holding a quality asset for 30 years will far, far outperform those intermittent, rapid gains that are constantly being interrupted by long breaks.
It requires a profound shift in discipline. So let's try to synthesize this whole philosophy down to its foundational pillars one last time.
Okay.
Because at the end of the day, the biggest difference between success and failure in investing isn't really intelligence, is it?
Not at all. It's the rare ability to resist that instinct to act, to tolerate the profound boredom of watching money grow slowly, and to focus ruthlessly on just avoiding bad decisions.
So if we define this approach, we can summarize it this way. In this world,
Unessential non-interruption is wisdom.
reducing transaction friction is rationality.
Finally, avoiding premature stop-loss is persistence.
That ability to resist the siren, call for action, that's the true secret.
It sounds so simple, but maintaining that rationality when Mr. Market is screaming and throwing prices around, that is the absolute test of a disciplined investor.
A truly powerful deep dive into patience and conviction, and it all connects. Compounding requires time. Time requires patience. Patience requires belief.
And that belief has to come from understanding the fundamentals of what you actually own.
So, to leave you with a final thought to mull over, consider this. What is one area of your life, and it could be beyond your investments, where you routinely confuse busy, immediate action with actual, fundamental, long-term achievement? Think about that framework. We'll see you next time for the next deep dive.